Hey, welcome back to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network, and you can check out all of our great podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Thursday, February 2nd. And joining me, as always, my friend, my partner, Dr. Orphe Divounguy, PhD economist. Dr. O, even a chump like me saw the 0.25 increase on the Fed rate. I called it. I'm taking a victory lap. You're coming with me. I think my dog could have called this.
It was a consensus, right? Everybody knew the Fed was going to go 25 basis points. And the big question is, what does it mean, right?
I asked the questions around here. What does it mean?
Yeah, economic weakness is everywhere. The employment cost index eased at the end of 2022 for the third quarter in a row, right? Showing basically meaning that labor costs are falling, or at least are growing at a much slower pace. They grew but are growing at a slower pace. They're coming down. Well, I expect wage inflation to come down as well. The Conference Board Consumer Confidence Survey shows consumer confidence fell in January after increasing slightly in December. It fell in January, reflecting fears of a coming recession. Despite decelerating inflation and rising incomes, consumers are choosing to spend less, and the savings rate is increasing again.
Who wrote that? That sounds like really, really smart.
That's me, my man. That's me. That's me. That's me. I come prepared.
I just love it when you quote yourself. That's awesome. You are a prolific contributor to the discussion on LinkedIn.
I try my best. I try my best for our audience, and I just kind of want to make sure they understand what's going on out there. And so we had a week full of economic data, and most of the data came in very, very weak, right? Reflecting economic weakness. The ISM Manufacturing Index also showed a contraction in manufacturing for the third month in a row. The index is now at the lowest level since the initial pandemic drop in economic activity. Consumer spending also down. The ADP employment report, which comes before the official Bureau of Labor Statistics employment or jobs report that will come out tomorrow, also showed huge decline in employment growth. So employment is likely to still continue to increase, but increase at a much slower pace. It's supposed to kind of stall, right? Employment growth is likely to stall. So the Fed is aware of all of this. And so they raise the rate, their key policy rate, 25 basis points. And the key question really for me is, did they do that? And did they slow down because they're concerned that they might end up doing too much? It's like a plane coming in for landing and the pilot cannot see the runway.
The economy is really, it's not about money and it's not about math. It's about people, their activity, their behaviors and their attitudes, right? I mean, that
expectations, their expectations. That's right.
So today, this morning, on Thursday, February 2nd, as we tape this, we came in, of course, yesterday at 25 basis points. The Bank of England, however, went in at 50. Why would their increase at this point be different? Connect the dots.
They're facing much higher inflation in the UK. Our inflation in the US is decelerating rapidly. There's a ton of economic weakness. I mean, we looked at the December GDP numbers, and in the December GDP numbers, what we learned was that purchases by domestic purchasers, so in other words, domestic spending, domestic consumption, only grew by 0.8%. That is almost a complete stalling, right? Remember, consumption makes up 70% of GDP. What that reveals is that the economic situation here at home, right, domestically, is very weak, and that the consumer has pulled back significantly, and that the U.S. economy is likely to ease further and potentially contract in 2023. And I think the Fed is aware of that. With inflation decelerating, perhaps it would not be wise to continue to raise interest rates at a rapid clip. And so what they're doing is they're pulling back, they're easing a little bit. Like I was saying, they're like a pilot that cannot see outside, that can't see the runway. Their instruments are off, and they have to rely on looking out the window to find the runway. The Fed is in that final approach. It needs to make it on the runway. But if it shuts off the engine too soon, they're afraid the plane might crash, right? We might end up getting that rebound in inflation. But at the same time, if they don't hit the brakes a little bit, we might miss the runway altogether and the plane will crash. So they have to thread that needle. And that's why they're easing back a little bit. And we're seeing even the language is slightly less hawkish at the Fed right now.
One last question. Let me start with this statement. In the last 2 sessions on Wall Street, they seem to like this a lot. A lot of green on the board. What do you expect to see, however, in the next few weeks? Now, I'm not talking about the stock market right now, but elsewhere in the economy, things that people can see. What would you expect to be able to see?
I think it's important to express why the Wall Street seems to be in the green. So Wall Street expected a bigger slowdown, much lower earnings than they got this earnings season. And they are probably reading into Chair Powell's comments that the Fed is going to be less hawkish, less interested in raising rates that much further, and that the potential for soft landing is there, right? That the consumer might not end up so weak in the end. And that's kind of the read on Wall Street. And of course, I'm very optimistic, and I've been from the very beginning that it's still possible to avoid that crash landing. Very, very possible. It's really in the hands of the Fed at this point, driving this economy and driving it towards that runway. And so I think Wall Street is confident that we might actually be able to avoid a crash landing. And that probably is due to the fact that even though employment growth is slowing, layoffs broadly remain somewhat low. But of course, things can change on a dime. So we have really no idea. We really have to keep watching this carefully, especially the labor market, because I think the Fed is paying more attention to the labor market now than everything else. Everything else is showing extreme weakness, but the labor market is staying somewhat strong. And I think the Fed is going to be watching the labor market and those wage growth numbers tomorrow.
Appreciate it as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.